how and why to invest in gold. That's the big question. And if you've made it this far, it's because deep down you already sense something. Gold isn't just a shiny metal. It's a silent response to the crises that never cease to recur. Currencies are born and die, governments change, banks collapse, but an ounce of gold always maintains its essence. The same thing that glittered on Tutankhamun's funerary mask can now secure the future of a modern family. Isn't that incredible? And here's what many don't know. Gold isn't a get-rich-quick investment. It's a shield against inflation, a bridge between generations, a piece that has withstood wars, bubbles, and the fall of empires. That's why, if you want to truly understand wealth, you need to understand gold. Stay with me until the end, because on this journey, you'll discover how to invest in gold step by step, its secrets, its advantages and risks, and above all, why it remains the preferred refuge of those who refuse to accept losing its value over time. And before we begin, I want to suggest a gesture of intention. Write the word eternity in the comments if you too wish for your wealth not to be fleeting, but as lasting as gold itself. Gold, the universal language of value. Gold has accompanied humanity for more than 6,000 years as one of the purest forms of expressing wealth. No matter the language spoken or which empire dominated the map, gold was always understood. It was accepted by the Greeks and Romans in their transactions. It was kept by the Egyptians in tombs that sought to defy eternity, and it was used by the Incas and Aztecs as a symbol of divine power. The fascinating thing is that unlike any other metal, gold never needed translation. A first-century Roman coin could have value in markets across Asia, Africa, or Europe, and centuries later, that same gold continued to be recognized as valuable. As languages died and empires fell, gold maintained a unique quality. It was a universal language of value. That quality remains true today. A 1-kilogram ingot can be sold in London, New York, or Dubai without losing legitimacy. There's no need to explain it, no need to translate it, no need to justify it. Gold retains its global acceptance, making it an asset with almost immediate international liquidity. When compared to modern currencies, the contrast is revealing. The US dollar, today's most powerful reserve currency, has been in circulation for just over 100 years. The euro, the symbol of the European Union, was born in 1999. Gold, on the other hand, has maintained its role for millennia, enduring wars, inflations, political crises, and the collapse of empires. A fact that proves it. According to the World Gold Council, in 2023, approximately 47% of global gold demand came from jewelry, 23% from central banks and governments, 24% from private investment, bullion, coins, ETFs, and the remainder from technological uses. This simultaneous presence in everyday life, in state reserves, and in financial markets confirms that gold is much more than a simple metal. It is a bridge between cultures, eras, and economies. We can think of it with this analogy. If fiat money is a local language with dialects and translations, gold is like music. Everyone understands it, everyone feels it, no matter where they come from. Scarcity, the secret of its strength. Gold has a power that no currency, not even the most solid, can match: its natural scarcity. While governments can print unlimited banknotes, causing inflation and loss of confidence, gold cannot be manufactured by decree. To obtain it, it must be extracted from the earth, with increasingly costly, complex, and limited processes. It is estimated that throughout human history, the total amount of gold extracted is around 210,000 tons. If all that gold were melted down and placed into a single block, it would barely fit 3 Olympic-sized swimming pools. That image says it all. A millennia-old heritage, compressed into such a small space, yet with a value exceeding $13 trillion at current prices. And most interestingly, each year, mining only adds between 2,500 and 3,000 new tons, or barely 1.5% more than the existing total. This very limited pace contrasts with the supply of modern currencies. In 2020 alone, in the midst of the pandemic, the U.S. Federal Reserve injected more than $3 trillion into the economy in a matter of months. This difference explains why gold remains relevant, even in the digital age. In fact, the difficulty of extraction is increasing. The richest mines have already been exploited, and new reserves are found in increasingly deeper or inaccessible locations, raising production costs. On average, producing an ounce of gold can cost between $1,200 and $1,400, depending on the region. This means that gold is not only scarce, but maintaining its flow to the market requires ever-increasing investment and technology. We can compare it to an inherited jewel. No matter how much fashions change or how many times the financial system is reformed, that jewel does not multiply on its own. Its rarity is what makes it valuable, and its permanence is what makes it a legacy. So when people talk about financial abundance, it's worth remembering that true abundance is built on what is limited and real, not on what can balloon out of control. Gold in times of storm. World economic history is full of financial storms, and in each one, gold has played a silent but fundamental role, serving as a safe haven when everything else collapses. Consider the 1970s, a period marked by the oil crisis. The price of crude oil soared, and with it, inflation became a monster that was difficult to control. The dollar, which had already abandoned the gold standard after Nixon's decision in 1971, began to lose credibility. In this context, gold went from $35 an ounce in 1971 to over $850 in 1980. In other words, it multiplied more than 20 times in less than a decade. A clear sign that, when confidence in paper money is shattered, gold becomes investors' safe haven. Another more recent example can be found in 2008 with the Lehman Brothers crisis and the collapse of the global financial system. Banks failed, stock markets plummeted, and the word bankruptcy echoed worldwide. Amidst this chaos, gold shone again. Its price went from $800 in 2008 to over $1,800 in 2011. It doubled in just 4 years, driven not by speculation, but by fear and the need to find a solid asset in a world in ruins. The interesting thing is that gold doesn't compete with the stock market in times of prosperity. Its role isn't to offer dizzying growth or constant dividends. Its true value is revealed when the storm rages, when other assets are faltering. Gold is like a beacon in the darkness. It doesn't hasten the arrival of prosperity, but it guides the way until calm returns. Today, with geopolitical tensions, record debt, and central banks printing unprecedented amounts of money, many are once again asking the same question: what will happen if the storm returns? And the historical answer always points to the same place: gold, the eternal refuge. And now I want to invite you to something special. Write in the comments the phrase, "I accept success and happiness in my life." If you understand that, like gold in times of storm, you too can be resilient and maintain your courage even in the midst of adversity. Gold in the face of wars and geopolitics. History shows time and again that when armies advance and borders burn, gold becomes much more than a precious metal. It becomes a tool of survival. During World War II, many families in Europe managed to escape Nazi occupation solely because they had jewelry or gold they could exchange as they fled. It didn't matter if the local currency had lost all its value or if banks had closed. A gold ring, a coin hidden in clothing, could guarantee food, shelter, and even safe passage to another country. In more recent years, conflicts like those in Venezuela, Ukraine, and Syria have served as a reminder of this same lesson. In economies devastated by war or hyperinflation, people turned to gold as a means of exchange. While currency crumbled, gold continued to be accepted at any border, in any market. Today, central banks know this too. According to the World Gold Council, central banks purchased more than 1,100 tons of gold in 2022, the largest annual acquisition in more than 50 years. Why? Because in a world of rising geopolitical tensions, where confidence in international currencies is being questioned, countries are seeking refuge in the same thing our ancestors sought: gold. Gold's advantage in times of war is not only its universal acceptance, but also its portability. A small ingot can store the value of a car, a house, or even an entire life. This ability to concentrate wealth in such a small space is what makes it incomparable to other financial assets. We can think of it like a parachute. You don't use it every day, nor do you expect to ever have to. But if the time comes to jump in the middle of a storm, you are grateful with all your heart to have it with you. That's why, in the financial world, gold continues to be considered the life insurance for wealth, an asset that does not depend on the stability of a bank, the peace of a territory, or the signature of a president. The power of numbers: 50 years of gold. In finance, few stories are as compelling as that of gold over the past 5 decades. In 1970, before President Richard Nixon definitively broke with the gold standard, an ounce cost just $35. Today, it exceeds $2,000 in international markets. This means that, in just over half a century, its value has multiplied almost 60-fold. To put this in perspective, if in 1970 you had kept $35 in cash under your mattress, that same amount would barely be enough to fill half a tank of gas in many countries today. But if instead you had bought an ounce of gold, today you would have an asset that could finance everything from a luxury vacation to part of a down payment on a home. Gold demonstrates an essential lesson here. It is not an asset designed to make you rich explosively, but to preserve and slowly multiply the value of what you own. Its apparent immobility is its true strength. What's interesting is comparing it to other assets. The S&P 500, for example, went from around 90 points in 1970 to over 4,000 in 2023, multiplying almost 45-fold. It's true, in terms of raw returns, the stock market outperformed gold. But while the stock market index suffered drops of 50% or more in crises like those of 2000 or 2008, gold tended to advance precisely when equities plummeted. That's its irreplaceable role, not as a substitute, but as a balance and a safe haven. Furthermore, the power of gold isn't measured solely in dollars. In countries where inflation has devastated the currency, like Argentina, Turkey, and Zimbabwe, gold has literally been a lifeline. While banknotes lost value week after week, those who held gold maintained a stable wealth that could even be exchanged on the black market or in other countries. Gold is not an asset of the immediate present. It is an asset of long-term, of patience, of thinking in generations. While financial empires are born and collapsed, while currencies are printed and forgotten, gold remains a silent witness to the power of time. Physical investment. Touching value with your hands. There's a world of difference between seeing a number on a screen and holding an ounce of pure gold in your hands. That shine, that cold weight, conveys something no stock chart can offer. The certainty that you're looking at a real, tangible value that has withstood empires and catastrophes for over 6,000 years. Physical gold is the oldest form of investment. Ingots, coins, certified pieces, each with its own symbolism and utility. Ingots, for example, are the most efficient way to acquire value. They range from small 1-gram pieces accessible to new savers to 1-kilo blocks that look like they've come straight from a movie vault. To put it into perspective, a 1-kilo ingot at current prices costs over $65,000, a fortune you can hold in one hand. Investment coins, on the other hand, play a different role. They provide liquidity. A South African Krugerrand, a Canadian maple leaf, an American eagle. They require no translation or explanation. They are accepted in any market around the world as universal credentials of wealth. And that turns each coin into a borderless financial passport. But here's the other side of the coin. Physical gold demands responsibility. The first question is obvious. How do you store it? The old myth of hiding it under the mattress sounds romantic, but in practice it entails enormous risks.
That's why many investors turn to bank-safe deposit boxes, private vaults, and even specialized insurance. Safekeeping gold has a cost, and that cost is part of the true price of the investment. Another crucial detail is authenticity. Counterfeits abound in the informal market and are sometimes so sophisticated that only certified laboratories can detect them. That's why a responsible investor buys from accredited refineries, official mints, or recognized dealers. Every serious ingot comes with a serial number, a certificate, and traceability that makes it more than just a piece of metal. It transforms it into a reliable asset. And yet, its greatest advantage remains the same as it has been for millennia: full ownership. A gold ingot in your hands doesn't depend on a bank, a digital contract, or the promise of a third party. It's there. It's yours. But that independence also entails care, logistics, and the awareness that wealth, when held in the palm of your hand, demands respect. Leave me a comment with the phrase, "I accept success and happiness in my life," if you understand that, like physical gold, true wealth is that which you can touch, feel, and protect with your own hands.
Invisible gold, futures, CFDs, and derivatives. There is a gold you never touch, a gold that neither shines nor weighs. It is the invisible gold of financial contracts, futures, CFDs, derivatives. Here, the precious metal ceases to be an ingot and becomes numbers, screens, bets on its price. Its first advantage is liquidity. You can enter and exit a position in a matter of seconds. In one click, you're in the market. In another, out of it. There are no vaults, no safe deposit boxes, no certificates to safeguard. Only contracts that allow you to win or lose based on price movements. Gold futures, for example, are standardized contracts traded on exchanges like the COMEX in New York. A single contract is equivalent to 100 ounces of gold, or more than $200,000 at current prices. Therefore, almost no investors buy the entire contract. They use margin. In other words, a security deposit that represents just a fraction of the total value. That's the promise and the danger. Because leverage multiplies the possibilities. With $10,000, you can control a $200,000 contract. But the same move that can double your capital can also evaporate it in a matter of minutes. Thousands of traders have learned through tears and losses that gold teaches patience and punishes greed. CFDs, contracts for difference, work similarly. You don't buy the gold, you just speculate on the difference between the entry and exit prices. They're popular because they allow you to invest with little initial capital and trade at any time. But they hide the same trap: overconfidence. Physical gold demands care. Digital gold demands discipline. It's no less serious for being intangible. On the contrary, its risks are invisible but devastating if not understood. Tell me in the comments, do you prefer the security of the tangible or the dynamism of the digital? Gold ETFs, a simple and powerful investment. Gold is no longer held solely in bullion or traded solely in futures contracts. There is a more accessible and practical intermediary that has democratized investment in this metal: gold ETFs. An ETF, or exchange-traded fund, is a publicly traded fund that replicates the value of an asset, in this case, gold. Buying it is as simple as purchasing a share from your usual broker. No vaults, no physical certificates, no complex contracts. One click and you're part of the gold market. There are mainly two main types of ETFs related to this metal. One, those that directly track the price of gold. Each share you buy is backed, in theory, by physical gold reserves held in international vaults. The best known is the SPDR Gold Shares, GLD, which manages more than $50 billion in physical gold, and whose reserves are stored in banks like HSBC in London. Buying a single share of this ETF is equivalent to owning a fraction of an ounce of gold, with minimal maintenance costs compared to acquiring and storing bullion on your own. Two, those that group together gold mining companies.
Here, you don't invest directly in the metal, but in those who produce it. Funds like the Van Eck Vectors Gold Miners ETF, GDX, bring together companies that explore, extract, and refine gold in different parts of the world. This type of investment is more volatile. The price of mining stocks can multiply when gold prices rise, but can also fall more sharply in times of uncertainty. The great advantage of ETFs is diversification and accessibility. While a 1 kilogram bullion can exceed $70,000, an ETF allows you to start with much smaller amounts, even as low as a few hundred. They also offer immediate liquidity. You can buy and sell in a matter of seconds during market hours. However, it's not all about simplicity. An ETF, even if it backs the price of gold, isn't direct ownership. You can't touch it, you can't feel its metallic weight. You're investing in a financial claim, not the metal itself. Therefore, understanding this difference is crucial. You choose convenience and liquidity in exchange for foregoing physical contact with wealth. Gold, in any form, is more than an investment. It's a reflection of how you understand security, patience, and the preservation of value. Mining and royalties, the business behind gold. Investing in gold doesn't always mean buying gold. Sometimes it means investing in those who extract it, or in those who know how to collect royalties without getting their hands dirty in the mine. Mining companies live and breathe the precious metal. Their profits are closely tied to the price of gold. If an ounce rises 10%, their profits can multiply much more, because production costs are usually relatively fixed. However, this same principle works against them when gold falls. Mines must continue to operate, workers must continue to be paid, and environmental and tax regulations remain constant. A gold mine isn't just about wealth, it's also about risk, debt, and sometimes litigation. On the other hand, there's a quieter but equally powerful model: royalty companies. These companies don't operate mines, they don't drill into the earth, they don't move tons of rock. What they do is finance projects in exchange for a percentage of future production. In other words, they turn gold into a steady stream of income without burdening operating costs. An emblematic example is Canada-based Franco-Nevada. Founded in the 1980s, it has established itself as the largest gold royalty and streaming company in the world. Its model is so solid that even in times of crisis, it continues to generate revenue while other producers struggle with costs, unions, or regulations. Today, Franco-Nevada owns royalties in more than 400 mining projects worldwide, diversifying its risk and achieving margins that exceed most traditional mining companies. For investors, the difference is clear. A mining company is like riding a roller coaster. It can offer vertigo and adrenaline, but also steep drops. A royalty company is more like a toll road. Every vehicle that passes leaves a portion of the road, regardless of whether the car owner is happy with their ride or not. Both paths have value, and intelligence lies in understanding when one or the other is best. Because in the world of gold, not everything that glitters is gold. Sometimes the real gold is in the business model. Gold as a legacy, not a fad. Gold never was, nor will it ever be, a fad. It's not a stock that rises and falls with the day's headlines, nor a cryptocurrency that depends on social media buzz. Gold belongs to another category, that of legacies. A grandfather who keeps a simple gold coin isn't thinking about himself. He's thinking about time, about permanence, about that grandchild who, 50 years from now, will be able to use that same coin as a store of value, regardless of whether the world changes its language, its politics, or its currencies. Few investments offer that promise. Over the past 50 years, we've seen inflation reduce the purchasing power of the dollar, the peso, and the pound sterling to ashes. To give you an idea, what bought $1 in 1970 now costs almost $7. And yet, an ounce of gold that was worth $35 back then now costs over $2,000. That's the difference between saving paper and saving permanence. Gold doesn't promise to make you rich overnight, but it does guarantee something even more valuable: continuity, an unbreakable line connecting generations. a golden thread that spans decades, governments, crises, and bubbles. In a world racing toward the immediate, gold invites us to think about the eternal, to remember that true wealth isn't always measured by what you earn in a month, but by what you manage to preserve over a lifetime. Leave the phrase, "I am prosperous and I attract wealth," in the comments if you understand that gold isn't a fad, but a legacy, a silent inheritance that transcends haste and becomes a financial testament. Gold isn't just a metal, it's memory, it's resilience, it's a symbol. While money changes its face, while banks fail and systems reinvent themselves, gold is still there, shiny, serene, eternal. Perhaps today isn't the time to buy a bullion or open an ETF. Perhaps the most valuable thing today is to understand that true wealth is not measured in bills, but in that which transcends generations. If this message resonated with you, it's because you're ready to take the next step on your financial journey. Subscribe and join me on this journey where together we'll learn to protect and multiply your legacy.